Chinese authorities appear to be running out of options. Every idea they continue to come up with is even more desperate than their last. And the latest has China's central bank short selling hundreds of billions of government bonds. At the same time, there's an ongoing and epic bond market rally. But why is there an epic bond market rally in the first place? Well, if you hear the central bank tell it, it's claiming there's a bond bubble, but they know the truth. It's not a bond bubble. People and institutions all around China are piling into safety and liquidity because of bad banks, bad money, and bad economy. As far as bad banks go, The Economist reported just last week that 40 small rural cooperatives disappeared in the final week in June, and we'll explore why that was. In terms of bad economy, this isn't just a deflationary mindset that is sweeping through China. The latest data from China shows there's actual and worsening deflation in consumer prices right now. Producer prices return to the dark side too. The more the Chinese government does, the worse you know it must be. And the more desperate they are when they're doing their things, well, there you go. Bad money, it's in the banks, it's in the deflation, it's also in the currency. Not only is CNY reaching new lows, Japan's yen is right there with it in such close fashion, the correlation between the pair is the highest in maybe forever. Because at the end of the day, bad banks, bad economy, bad money, that's not just a China thing or a Japan thing. It is a globally synchronized thing. And we can see that in a number of ways, starting with this currency pair. As Bloomberg reported, Asia's two most important currencies are moving together like never before, increasing the risk of a broad decline among the regional peers amid the relentless strength of the dollar. Why is it relentlessly strong? That's the question. The 120-day correlation between the dollar yuan and dollar yen currency pairs climbed to 0.54 this week, a record high in data compiled by Bloomberg starting in 2007. And what everybody will tell you, the same thing over and over, is this is all Jay Powell's fault. Because the Federal Reserve won't commit to an aggressive and close series of rate cuts. Therefore, this is pressuring currency pairs all across the spectrum. The dollar is strong because of interest rate differentials or something else. And as I showed in the recent video, it just doesn't stand up to the evidence, especially in 2024, and especially where it comes to China and Japan. Where things stand right now with China, CNY is falling down again, nearly 728 today. That's the lowest since November 13th, another new low. Japan's yen, just by the way, almost 162 again. That is a new low, lowest since, 1986, many years. Both of them falling in lockstep fashion. The PBOC has been trying to arrest CNY's fall. They had been fixing the midpoint, the daily midpoint stronger, starting last Thursday, Friday, and then again Monday. And they do this from time to time to try to interrupt the trend in CNY, to try to maybe get it to stabilize and maybe move higher if they can. They've also been messing with the offshore yuan exchange value, CNH. That one got down to 731, pretty low last week, and then a bunch of stuff happened. Looks like the PBOC was issuing bills again to soak up what they call excess liquidity, making it harder to short the onshore yuan rate. But anyway, CNH was down 731 last week. It pulled back to 728.59 on Monday, got a little bit stronger, and now it's moving lower again, though only 729. So the onshore rate is actually weaker now than the offshore rate is, though it's very likely the offshore rate was going to zoom right past it and go even weaker still. And everybody says it's Jay Powell, it's policy differentials, that kind of a thing. The Fed holding interest rates, short-term interest rates higher for a lot longer as Powell continues to dither about whether or not he wants to cut rates, whether or not he's confident in terms of consumer prices, whether or not he wants to really focus on unemployment that's becoming a bigger problem. Mainstream explanation is it's all about the Fed, because that's all they ever talk about. That's all anyone ever talks about, is some government institution somewhere. If something happens in the world, we have to blame or at least tie it back to a central bank, when that's almost never the case. I won't say never. It's almost never the case. Now, to get behind all of these myths and mistaken assumptions about how money, finance, and the global economy work, that's why Eurodollar University offers memberships and subscriptions. And they are now on sale at some of the lowest prices we've ever offered. We got tons of videos on everything from the basics of money and financial concepts, even the basics of QE and QT, So you just won't get anywhere else. You got loads of history and background material on how it all really works. We've got a daily deep dive where we dive far deeper behind all of these topics that I bring up here on YouTube, as well as a daily briefing that keeps you up to date on everything that's happening in money and macro. Again, anniversary sale for a limited time, some of our best prices. Check it all out at our website, Eurodollar.university. Digging a little bit deeper into China's banking situation, there has been rumors this week about a bank failure called Jiangxi in China. It's a smaller cooperative bank, which is sort of the target of what we're talking about here. And there's been a lot of rumors. There's a video circulating on X or Twitter, which shows what looks like the headquarters of the bank and a bunch of people outside chanting that they want their money back. The implication that it is somehow the beginning of some systemic setback in the Chinese banking system. And that follows a report earlier last week from The Economist, which showed and which confirmed that 40 banks in China had quote unquote disappeared. Well, here's what The Economist wrote. In the week ending June 24th, Chinese banks vanished as they were absorbed into bigger ones. Of the 40 institutions that vanished recently, 36 were in the province of Liaoning and absorbed into a new lender called Liaoning Rural Commercial Bank, which was created as a receptacle for bad banks. Since it was set up in September last year, 5 other institutions have been established to do similar work, and more are expected. This regulatory vanishing act will probably pick up pace. S&P Global, a rating agency, reckons it will take a decade to complete the project. Supporters say that fewer big banks will be easier for regulators to keep watch over, while critics argue that it is a little more than a sleight of hand. Combining dozens of bad banks, they say, only creates bigger, badder banks. And this is really first of all, it's a desperate act of extend and pretend because China has a massive banking problem on its hands, not just real estate. There's lots of bad debts to take care of too. And China's smaller cooperative banks have been largely unregulated, unsupervised, and into a whole bunch of different things for many, many years. While everybody was focused on real estate in the 2010s, trying to stabilize China's economy and trying to keep everything on track, some of the smaller banks, with the acknowledgement of local governments, got into a whole bunch of different areas. So this is part of China's attempt to clean up its banking system, or at least to clean out its banking system and to re-energize the system as it really struggles to stabilize everything, including the economy. So this isn't necessarily a surprise. In fact, as Bloomberg reported back in January, this was something the Chinese government announced as part of their plans for revitalization. China is embarking on its biggest consolidation in the banking industry by merging hundreds of rural lenders into regional behemoths amid growing signs of financial stress. That's the key part we come back to. The government had since authorized 7 provinces to consolidate their over 500 smaller lenders, either through mergers or a shareholding structure, at least according to data compiled by Bloomberg. While the mergers created bigger financial institutions, they aren't necessarily stronger because the transactions weren't always done in a market-oriented approach. And as we just said, sometimes creating a bigger single bad bank creates a bigger single bad problem, especially if that larger bad bank experiences its own funding difficulties. Sometimes it's better to try to handle several small fires than put them together in one big conflagration. So this is part of China's effort to revitalize the banking system. So what The Economist reported as far as 40 banks vanishing in the end of June is more a question of why now. Because there was there's no warning that this was going to take place, and not that we should expect one from the Chinese government. But essentially you have to wonder if something is going on, something has changed more recently. And then that, of course, flows into the rumors this week of Jiangxi Bank and maybe a bank failure, bankruptcy there. But that remains unconfirmed. We don't see any official reports anywhere. We don't really know what's going on there, but that's part of the problem too. Again, in the backdrop of China's economy, which we already know is bad and getting worse, as we'll see in just a moment, you've got a banking system that continues to behave in this way with very little information. If any information comes from the government, you can at least understand why there is an epic bond market rally. Everyone knows the economy sucks and it's not getting any better. External economy is not helping at all. And everybody also knows that China has a massive real estate problem that was funded in a lot of stupid and insane ways by the banking system. So therefore, this is not just a real estate issue, this is also an internal bank issue. So what we're seeing from China's banks and from China's regulatory authorities is an increasingly desperate move to try to get everything under control. And people understand there are tremendous risks in the process in doing it. There's no guarantee this works out well. Well, it's a bad bet to underestimate China's ability to hold everything together given a bad set of circumstances. That doesn't eliminate the possibilities. And some bad possibilities, including that nothing changes. The Chinese economy continues to slowly get worse. The financial system never really does get revitalized, even if it doesn't have a wave of bank failures. That's not necessarily the only bad outcome here. And all of it leads you to believe people are acting prudently in demanding safety and liquidity in Chinese government bonds. But that clear demand for safety and liquidity in Chinese government bonds goes against everything that Beijing is trying to accomplish. They're trying to convince the world, they're trying to convince China, the rest of China, that everything is fine, it's under control. An unrequited demand for safety and liquidity goes right against the idea that Beijing has everything handled and will work out, and everything will work out just fine. Instead, the incessant demand for safety and liquidity shows that people are increasingly anxious and nervous with every reason to be. So the Chinese government has issued 10 separate warnings since April, just since April, that it would do something about falling bond yields. And every time they issue a warning, bond yields will pop up by a few basis points and they'll go right back down again as if it never happened. Now, the 10-year Chinese government bond yield had gone sideways for a while, but then it moved lower to a record low just recently, prompting the PBOC to announce that it had armed itself with agreements to borrow hundreds of billions of yuan from Chinese banks, some of the biggest banks, in order to short sell them into the market to try to short circuit this bond market rally. As Bloomberg reported last Friday, after months of investor speculation about its intentions, the People's Bank of China disclosed the clearest outline yet of its unprecedented plans in a statement to Bloomberg News on Friday. It said it has hundreds of billions of yuan worth of medium and long-term bonds at its disposal to borrow after signing agreements with several major financial institutions. The central bank said it would borrow the bonds on an open-ended and unsecured basis and sell them depending on market conditions. You know how that conversation went. Yeah, I'm here from the PBOC. I need to borrow hundreds of billions of bonds from you, Mr. Banker. And Mr. Banker said, I would rather not unless you put up some kind of collateral. And the government, the central bankers responded with, yeah, Xi Jinping isn't going to give you any collateral. You're just going to give me the bonds to sell them as I see fit. And oh, by the way, I'll give them back to you when I feel like it, or whatever price I probably feel like it too. But with all that going on, you can understand the problem here from both perspectives. From the government's perspective, they're trying to get a hold of the situation, so they don't want the bond rally to continue. They can call it a bond bubble all they want. In fact, a lot of people are repeating that line, but they know the difference here. And even those who are calling it a bond bubble, such as an article in CNN just recently, they referred to this as a bond bubble, but then they got to the real truth behind it, which the PBOC knows. Here's what CNN said. Prices of Chinese bonds have risen fast since early this year as investors pile into them because of the uncertain economic outlook, an uncertain financial and banking outlook too. Businesses are also borrowing less because of the economy, leaving banks with excess cash that they have to park somewhere. A quote, deflationary outlook for the economy has also taken hold among investors, prompting them to flock to long-term sovereign bonds, which is safety and liquidity. Everything about China right now, including the desperate acts of its authorities, they show you exactly why there would be demand for safety and liquidity. There's not a whole lot of trust in stimulus because it hasn't worked thus far, so why would it suddenly start working? We don't know what's going on in the banking system, so with the economy not responding, with more risk there, no external help, the banking system is a mess, bond rally makes sense. It's the only thing that makes sense. It's the only prudent move, not just for Chinese investors, also for Chinese institutional investors, and as the CNN article just pointed out, for Chinese banks themselves too. They're not buying into this whole stability thing either. What the Chinese government reported late last night, early morning their time, was that it's not just a deflationary outlook, it's actually deflationary in the economy right now. According to China's National Bureau of Statistics, the country's CPI fell by 0.2% month over month in the month of June. That was worse than had been expected, and it's also the second straight decline. In fact, China's CPI has been down on a monthly basis in 5 out of the last 9 months, including 3 of the last 4. And over those last 4 months, China's CPI is down at a 1.2% rate, not annual rate. It's down 1.2% in that 4-month period, which works out to an annual rate of close to 4%. Declining consumer prices, close to 4% annual rate over the last 4 months. That's not a deflationary outlook, that's a deflationary reality. And it's widespread. It's not just one part of the consumer price bucket. Services were flat, so no growth and no increase in prices on average in services. Food prices were down 0.6% in June, and consumer goods were down 0.4%, showing just how weak it is among consumers and consumer spending in China. It wasn't just consumer prices, producer prices also declined in the month of June. China's PPI was down 0.2% after being briefly positive in the month of May because of copper and aluminum prices that were squeezed higher on supply considerations in the month of May. Factory gate prices were still positive, though less positive in June because there's still that lingering after effect of the supply squeeze in some of these big metals, which only makes the situation worse because China's producers are paying a little bit more at the factory gate for raw material coming in and getting a little bit less at finished goods that are going out the front of the factory and being sold into the wholesale marketplace. So it's not a deflationary outlook, it's a deflationary reality in every sense of the term, including the potential disruption in money and credit flow. Is there really a bond bubble? Bad money, bad banks, bad economy. It doesn't sound like it. It sounds like the textbook case for safety and liquidity. Bond market demand makes absolutely perfect sense. And that's a problem for China's authorities. Why? One reason why they're becoming increasingly desperate. Short selling hundreds of billions of bonds to try to interrupt what is nothing more than a prudent reaction to everything that's actually happening, including being skeptical about authorities' ability to do something about it, because authorities have only shown they become increasingly desperate and become increasingly stupid in their ideas. Safety and liquidity sounds about right. It's just not the sound the government would like to hear. Now we've got strong co-movements between the yen and the yuan, which show this isn't just about China or Japan. It's a global negative. It sure as hell isn't about Jay Powell. Now what they all tell you is that everything's good. And how long have we heard about the soft landing in the US? They kept telling us that this was assured, only now there's a mini panic here in the US, among especially economists, with the unemployment rate rising. They told you it was fine, soft landing. Oh crap, it's not. So in a place like China, where things are even more advanced to the downside, bad money, bad economy, bad banks, and all of that, you can understand the appeal of government bonds as nothing more than a hedge against some really adverse cases. But they're not just adverse future cases as a deflationary outlook, it's right now. Again, as I said, you don't want to underestimate the ability of the Chinese government to hold everything together, even under some of the most biggest and most negative strains. But even then, just holding everything together is not a positive outcome itself. And it doesn't preclude the fact that some of those alternative worst case scenarios might still happen along the way too. In fact, the risks of those happening are rising all the time. So the best case, if you're in China looking into China, looking outside of China, the best case is essentially that they do hold everything together and it just gets worse slowly over time, slowly strangling the economy, the financial system, the monetary system, and everything. That explains not only the bond rally, but also what we see in currency movements. And what we see in currency movements means this isn't just something for China to worry about. They keep telling us the yuan and the yen are falling because of policy differentials. But what does the actual evidence show? Well, I went over it in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's anniversary sale. If you are a new member or an existing member and subscriber, I cannot thank you enough. And until next time, take care.